Welcome to An Idiot with a MBA, where business gets broken down without all the buzzwords. I've got the degree, but I still ask the dumb questions, so you don't have to. Let's get into it.
Hi, I'm Chad, and yes, I am the idiot with an MBA. I want to start out by giving you a little bit of my background so you understand where I'm coming from and what I'm all about. I have an undergrad degree in finance. I have an MBA, surprise, with a concentration in finance, aka another minor in finance. I work for a financial company. My position is not completely in finance, it's more in an IT related role, but I do a lot of financial things within my position. But I bring in some of the IT components as well. I wouldn't call myself a tech guy, but through many, many years in the company, I've evolved into this position. In my undergrad, my first choice was actually marketing. And then I found out going through marketing classes that I actually hated the marketing classes. And when I looked at what I could do with the entry level position in marketing, I didn't like any of the marketing classes and marketing jobs. And so even though I was really good at my marketing classes, I decided marketing was not for me. So I went to my second choice, which was finance. And actually, I'm really glad I did that. So I thought I would come up and start this YouTube channel to kind of bring the thoughts that I have when it comes to different business topics, business ideas, what's in the news, etc. Because a lot of stuff comes up, and I always have a lot of thoughts and opinions on things, and I thought I would come on here, share what I'm thinking, maybe teach a couple things here or there, and go from there. Now, even though what I do professionally doesn't do anything with personal finance, I am very into personal finance, and I have spent a lot of time and energy keeping up with researching, doing deeper dives into personal finance, especially when it comes to investments. I would make an argument that I understand investing and personal finance probably more than the vast majority of people out there, including, I would argue, even financial advisors. Some may disagree with me on that, but that's my opinion. And I give all that background because it brings up the first thing I want to talk about. As my intro said, I'm not afraid to ask stupid questions. If you're like me, your phone kind of gets to know you. Kind of scary on how well it gets to know you. And it pushes quite a few financial articles. One particular thing I've been watching quite a bit is UnitedHealth. If you've been following UnitedHealth, you know it's been hit with a lot of bad news lately, and the stock has suffered because of it. I've been kind of wondering if it is a good time to buy into it and ride the wave up. That would probably be a topic for a different video. But I got an article. It said the board of directors are urging the shareholders to reject a mini tender offer. And I'm going to be honest, I had no clue what a mini tender offer was. For somebody who self-proclaims to know a lot about personal finance, investing, stocks, etc., I had no clue what they were talking about. So I did some deep diving. I looked more into it. I thought I would share with you my thoughts and what I found out. So what I first was thinking was, if the board of directors of a Fortune essentially 100 company is commenting on a mini tender offer, I first thought was like, is some company trying to purchase the company? Because that's when the board of directors come into play. And a lot of times the shareholders don't necessarily vote on if they're going to sell the company or not. The board of directors can make that decision on their own. So I don't know why they're why they're coming to the shareholders, because I haven't seen anything stating like a proxy vote's coming out or there's a mandatory shareholder vote on any topics. That wasn't the case here. What a mini tender offer is investor is reaching out to current shareholders saying, hey, we want to buy your shares. they're looking to buy shares from current shareholders and not going out into the open market to buy shares. In this case, it's an investment company. I'm not going to name the company because one, I don't necessarily know how to pronounce it, and two, it's not relevant. They're trying to buy something like 1 to 2%, under 10% of the company, and that's important here, by buying shares off of current shareholders. And they do this by sending out letters, emails, etc. to current shareholders saying, hey, I want to buy your shares. And I want to buy your shares at a set price. This offer was at $325. If you look at UnitedHealth, right now it's trading right around 300, 310, maybe 320. So you're like, hey, if I could sell it to you for $325, that's a pretty good deal. But there's some catches. There's always catches. And this is where I got confused. So the catch with this is there will be a date in which the transaction closes. And actually, by the time I got this article, the date had passed, but I'll get a little bit more into that. And the catch is the price of the stock must be at the offer price or higher on that date. So for this example, it must be at $325 at the date that the transaction is supposed to close. So let's say UnitedHealth ran up to $350. Wonderful. They're still buying your shares from you for $325. If UnitedHealth shares is below $325, they're not buying your shares. At least not on that day. You see, because they also have the option to extend the offer. So push the date out up to 90 days. And they pick how long they want to do it. And they can push it up to 90 days and say that we can close anytime up to those 90 days. If you're kind of familiar with investing, this sounds a lot like stock options. And that's what my first thought went into. They are essentially selling covered calls or buying, or not selling covered calls, they're buying a call option. They are buying the right to purchase stock at a specified price on or before a specified date. That's the definition of a call option. And so they're purchasing less than 10%. They're buying less than 5%. Why are these percentages important? It's not illegal to buy shares in a company. Actually, if you stay below a certain threshold, it's usually 5%, 10%, you don't even have to disclose that you own shares in the company. Once you get to that 5% and 10% range, then there's some SEC paperwork you have to file within certain time frames. You can delay filing it. There's certain techniques you can do to kind of delay to kind of hide your ownership. This is done by a lot of hedge funds when they're trying to do corporate takeovers, etc. But the delay is not years. We're talking maybe weeks, maybe a month or two. But those companies aren't trying to do that. They're looking like the 1 to 2%, maybe 1% of the company. So why not just go and buy it on the open market? That part really confused me. I couldn't quite figure this one out. And I think the biggest thing was they just wanted to have full control and a little bit of privacy around the transaction. Now, unfortunately, it kind of got out in the news, got up to UnitedHealth when it was going on, and so they didn't get the privacy that they wanted. But I think a lot of investors, investment companies, they try to use this tactic, do it because they want to kind of fly under the radar. And that's really where the benefit is. The other thing is they wanted to control the pricing. So if they would go on the open market, you can't control how much the stock is going to trade day to day. And they want to buy, I want to say it's like 175,000 shares, which is quite a bit. But it was roughly, when I looked it up, maybe 1 to 2%, maybe 3%. It was not a significant amount of the daily volume of UnitedHealth when I looked it up. And so they could easily buy it maybe over the course of 2 days, or easily within a week, these shares. No, United could go for a run, and they could end up maybe paying more than $3.25. So they want to make sure they bought in at $3.25. They could buy, as they said, call options. But that comes at a cost, and I'm going to go through the cost here shortly. And so the cheapest way maybe for them to do this and guarantee the pricing is to go out and ask people who currently own the stock, saying, hey, will you sell it to me for $3.25? And if you're holding these shares at $300, you're like, yeah, I will. But they don't get the fine print realizing the stock has to be at $3.25 at the date of closing, or else it's no deal. And if the stock is higher, it's a deal, but you're selling it less than market value. So if you're in this situation and you're like, I hold this stock, I got this letter, someone wants to buy the stock from me. Yeah, I have no problem selling it for $3.25. What's the better option? Best option, I think, covered calls. So that you can buy a call, which gives you the right to purchase a stock at a specified price. That's what this company is trying to do. You can do a covered call. You can sell that right. So you can sell the right to somebody to buy your shares at that certain price. Now, $3.25 is not really a price point that options are sold at. So I looked at the $3.20 price point for August, September, and December. And the reason why I chose these months is because these are generally probably going to be when this deal would close. In August, you could sell that right around $18 per share. So if you're not familiar with stock options, a contract encompasses 100 shares. So that's $1,800 that you get paid. As soon as you hit confirm on your order, $1,800 shows up in your account. If the stock price runs up over $3.20, great. By the time expiration comes around, those shares will disappear from your account, and you'll get paid out $320 per share at that point, and you keep the $1,800. September and December, it jumps up quite a bit. The pricing is roughly around the same for September and December. Again, without actually putting an order in, they would be slightly different. September should be cheaper than December, but you have a bid-ask spread associated with all this. But you're looking right around $30 to $35 for September and December. That's $33,000 to $3,500 in your account. You go with this investment company, they're not giving you a penny for the right to hold your stock hostage until this deal closes. So for all the time that I have been investing, I've never received a mini tender offer. And I guess it's probably a good thing because I never would have even considered it. And when I saw this article, it never made sense to me. And I guess I can see why, because it makes no sense to me why anybody would take it. And I'm glad I did a deep dive into this because now I have a better understanding of what it is and why the board of directors thought so much that they needed to come out and say, don't accept this offer. It makes no sense. And I think they also have alternative motives, because if an investment company is trying to come up with a larger stake in a company under the radar, there could be some other motivations behind that in trying to accumulate shares and maybe try to get a board position and try to push management out and try to take over leadership. But overall, if you ever got a mini tender offer, I think there's other options you can look at. Literally, call options. If you want me to do a deeper dive into options, let me know. I have no problem doing that. But I hope you stick around, like and subscribe, and let me know anything else you'd like me to talk about. Until next time, have a great day.